Hey everyone, welcome back to Corporate Decoder, the place where we untangle the tricky world of corporate finance and tell you what is really going on behind those official filings. Today, it seems like iQSTEL Incorporated might be trying to add a new twist to their preferred stock, and we're going to decode exactly what that means for you. Before we dive deep into this report, if you're someone who likes cutting through the corporate jargon and getting to the heart of what matters, make sure you're subscribed. We also have a fantastic Discord community linked in the description below where we discuss these filings and more. Alright, so we're relooking at a Form 8K filing from iQSTEL Incorporated dated the 10th of October 2025. What is an 8K, you ask? Think of it as a document companies file to announce big important news that isn't part of their regular quarterly or annual reports. It is like their breaking news channel to the seek. The big news here is all about their Series D preferred stock. Now, preferred stock can be a bit confusing, but think of it as a special kind of stock that usually gets some perks over regular common stock, like getting paid dividends. First, iQSTEL has decided to restate or update the rules for this Series D preferred stock. They originally set it up a couple of years ago and have tweaked it since. This latest update, filed on the 10th of October 2025, doesn't change the number of these special shares they can issue, which stays at 100,000. But they are changing how these shares convert into regular common stock, and that is where things get interesting. First off, let's talk about the dividends. These Series D shareholders are entitled to a 12% dividend. This dividend accrues, meaning it builds up from when the stock is issued. It is paid out only if the board of directors decides to pay it, and it is calculated on a 360-day year, which is a common practice in finance. If the shares are converted before a full year is up, they get a portion of the dividend. This is a pretty standard feature for preferred stock, offering a fixed income potential. Now, the conversion part, after 3 months from when the preferred stock is issued, the holders have the option to swap their preferred shares for regular common stock. The base rate, or the starting point for this swap, is 12.5 shares of iQSTEL, as common stock for every 1 share of Series D preferred stock. This rate can change or be adjusted if the company does things like a stock split, pays a stock dividend, or goes through a reorganization. This is just to make sure the number of shares the investor gets stays fair. But here is the really spicy part, the true up adjustment mechanism. This is designed to protect the investor if the common stock price drops significantly. Let S break it down. When the preferred stock was first issued, the conversion price was based on the average stock price over 10 days with a 20% discount. Now, when the investor decides to convert their shares, the company will look at the lowest daily stock price in the 5 trading days before the conversion. They'll apply another 20% discount to that lowest price. This new, lower price is called the adjusted conversion price. If this adjusted price is lower than the original conversion price, the investor might get more common shares. This is what they call a true up adjustment. It's like a guarantee against a rapidly falling stock price. They put a floor on this price though. It won't go below $1. And to cap it off, the total number of extra shares they can get through this adjustment is limited to 2.5 times their original conversion. This mechanism is essentially a way for the company to ensure that the preferred shareholders receive a certain value, even if the common stock price takes a nosedive. It can lead to significant dilution for common shareholders if the stock price tanks. The company also has an option to buy back these preferred shares. If iQSTEL decides to redeem them, they pay the holder 105% of what they originally paid. They can do this with just a few days' notice. This gives the company flexibility to get rid of this preferred stock if they think it is no longer beneficial for them, perhaps if they have enough cash or better investment opportunities. In the unfortunate event that the company goes bankrupt or is dissolved, the Series D preferred shareholders have a pretty strong claim on the company's assets. They rank higher than common stockholders and Series A and C preferred stockholders. They are on equal footing with Series B preferred stockholders. This means they'd get their money back before many others if the company liquidates. Typically, preferred stock doesn't have voting rights that influence the day-to-day running of the company, and that is the case here. The Series D holders can't vote on company matters, unless the law requires it, or if there are changes to the company's core founding documents, or the terms of their own preferred stock that would negatively affect them. There is also a leak-out restriction after the initial 3 months if preferred shareholders want to convert their shares into common stock, and then sell those common shares they re-limited. They can only sell up to 10% of the average daily trading volume for iQSTEL, as common stock each day for each holder. This is a common way for companies to try and prevent a flood of new shares hitting the market all at once, which could drive the stock price down. It's a way to manage the impact on the stock price when these large blocks of shares become available. This filing mainly establishes the amended terms of the Series D preferred stock. It doesn't contain new financial statements or tables to analyze here, but it is crucial because these changes in preferred stock terms can have a significant impact on the company's future financial picture, especially concerning potential dilution of common stock if that true-up adjustment is triggered. So, what is the story here? iQSTEL Incorporated is essentially tweaking the conversion terms of its Series D preferred stock. They've added a mechanism that could give preferred shareholders more common shares if the company's stock price falls significantly. This protects the preferred investors but can lead to a lot more common shares being issued, diluting existing common shareholders. It is a move that offers more security to the preferred class, but introduces higher risk of dilution for the common class. Companies often use preferred stock and these kinds of adjustments to raise capital when they might not be able to do so on as favorable terms with just common stock. Looking at this filing, the main thing to understand is the potential for dilution. The true-up adjustment is the key here. If iQSTEL's stock price continues to struggle or declines, holders of this Series D preferred stock could end up owning a much larger percentage of the company than initially anticipated by receiving a significantly increased number of common shares. This is a significant risk for current common shareholders because their ownership stake and the value of their shares could be lessened. On the other hand, it might have helped the company secure funding that wasn't available on better terms. My take on this is that it's a classic move to attract capital when market conditions might not be ideal for issuing straight common stock. The company is essentially offering a safety net to these preferred investors, but the cost of that safety net is borne by the common shareholders through potential dilution. It signals that iQSTEL may anticipate a volatile stock price or needs to incentivize investment in a way that common stock alone can't provide at this moment. The risk for iQSTEL is that a significant drop in its stock price could trigger large issuances of new shares, severely impacting the value for its common shareholders, and potentially setting a precedent for how future financing rounds are structured. A key opportunity for the company is that this might allow them to raise necessary funds to execute their business strategy, which is often the ultimate goal of such financing activities. A notable risk here is uncontrolled dilution, which can make it very difficult for the common stock to regain value. In conclusion, this filing shows a company leveraging preferred stock to secure capital, but with terms that clearly prioritize investor protection over common shareholder interest during adverse market movements. Alright, that is our breakdown of iQSTEL's latest filing. What is your take on these preferred stock terms and what they signal for the company's future? Do you think this is a smart move to get funding or a raw deal for common shareholders? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep corporate dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.